This is an Uncovered Japan Company research report on Tokai Rika, ticker 6995. It is a Japanese auto parts maker whose products are easy to overlook but are all around the driver. Smart keys, steering wheel controls, seatbelts, and shifters. The investment story combines a deep Toyota relationship, improving profitability, and a valuation that still sits below book value. At the report's reference date, Tokai Rika traded on roughly 8.6 times forward earnings and 0.71 times book value, while offering a 4.15% dividend yield. Those are unusually low valuation markers for a company with a 9% return on equity, but they coexist with important risks, its reliance on Toyota, and a modest record on buybacks. Tokai Rika calls its franchise the boundary between human and car. Its 5 product families include smart and digital keys, cockpit human-machine interfaces such as steering switches and hidden controls, occupant restraints, electronic shifters, and automotive security. Smart keys and HMI are the structural growth categories, while seatbelts provide a durable, safety-regulated base. The key fact is customer concentration. Toyota Motor accounts for more than 70% of sales, and the wider Toyota Group, roughly 80%. That creates a stable order book and a 4-decade co-development relationship, reinforced by Toyota's roughly 32% shareholding. But a Toyota production cut, recall, or demand shock would flow almost directly into Tokai Rika's revenue. The moat is not scale. Tokai Rika is only around 1/12 the size of Denso by revenue. Instead, its defensibility comes from decades of Toyota qualification, full in-house control of design through quality assurance, and specialized access and security technology. Its UWB and Bluetooth digital keys, together with quantum encryption anti-theft work, differentiate it in a niche where switching suppliers takes years. Over the 5 fiscal years to March 2026, revenue rose from 487 billion yen to 645 billion, a 7.2% compound annual growth rate. More important, operating profit nearly quadrupled from 9.2 billion yen to 35.6 billion, lifting the operating margin from 1.9% to 5.5%. The segment split reveals the next challenge. Asia produced a 12.7% operating margin and about 2/3 of group operating profit. Japan, meanwhile, accounted for 47% of sales, but only a 0.4% margin, reflecting head office and research costs. Raising Japan's profitability is the largest controllable lever in the medium-term plan. Tokai Rika pairs its earnings recovery with a very strong balance sheet. The FY 2026 equity ratio was 63.4%. Return on equity reached 9%, and net cash was around 90 billion yen. That balance sheet provides resilience during auto cycles, but it also makes capital allocation a live issue. Investors will watch for buybacks, dividends, or disciplined software and SDV-related acquisitions. Management's TRV 2030 plan targets 700 billion yen of revenue, a 7% operating margin, and 10% return on equity by the year ending March 2031. From the current base, the revenue target implies only around 2% annual growth. The more important value driver is margin expansion through higher value digital keys and HMI, restructuring and automation. Against Toyota Group peers, Tokai Rika traded on an 8.6 times forward price-to-earnings multiple, below the 10.3 times peer average. Its price-to-book ratio was the lowest in the group, while its 4.15% dividend yield was the highest. The discount is not irrational, but the report argues it is wider than the quality of the balance sheet, operating margin, and return on equity would suggest. The report's 3-year scenario analysis is illustrative, not a recommendation or a price target. Its bear case is about 2,000 yen, the base case about 4,100 yen, and the bull case about 6,000 yen, against a reference price of 2,890 yen. The variables to watch are Toyota concentration, Japan's margin recovery, US tariffs, foreign exchange, and whether digital keys retain their value as Apple and Google shape industry standards. Tokai Rika is a niche leader in the driver-facing systems inside a car, anchored by a long Toyota relationship, stronger profitability, and a fortress balance sheet. The stock's discount reflects real concentration and execution risks. The most useful indicators are whether non-Toyota business expands, whether Japan's margin improves, and whether management turns its cash strength into higher shareholder returns. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.